Ind AS 2. Inventories. Definition of inventory. Inventories are assets which are held for sale in ordinary course of business, that is finished goods, or which are used in production process for such sale, that is work in progress, or which are in the form of materials or supplies to be consumed in the production process or in rendering the services, that is raw materials. So there are three types of inventories: finished goods, work in progress, raw materials. Measurement of inventory. Inventories are valued at cost or NRV, whichever is lower. The comparison between cost and NRV should be made item by item wise or by group of item wise. What is the difference between NRV and fair value less cost to sell? NRV is entity specific value, whereas fair value is market based measurement. So NRV is entity specific value, and fair value is generally market selling price. Fair value less cost to sell means net market selling price. For example, an entity holds inventories of 10,000 units and it could sell the same in the market at rupees 10 each. The entity has an order in hand to sell the inventory at rupees 11. Rupees 11. The incremental selling cost per unit is 0.50 per unit. In this situation, fair value is rupees 10 each, but net realizable value is 10.5 each. That is 11 minus 0.5, 10.5. Next, cost of inventory. Inventory cost includes cost of purchase, conversion cost, other cost. Cost of purchase. How to calculate purchase cost? Purchase price less trade discount, less rebates. Add duties and non-refundable taxes. Add all directly attributable expenses like handling cost, freight, transport expense, insurance of purchases, brokerage commission paid to indenting agent, that is buying agent, etc. Conversion cost. Conversion cost is of two types: direct cost, indirect cost. Direct cost includes direct material, direct labor, direct expenses. Indirect cost, that is overheads. Systematic allocation of overheads. Overheads are of two types: fixed overheads, variable overheads. Variable overheads allocation will be done based on actual capacity, whereas fixed overheads allocation will be done based on actual capacity or normal capacity, whichever is higher. If actual capacity is more than normal capacity, fixed overhead allocation will be done based on actual capacity. If actual capacity is less than normal capacity, fixed overhead allocation will be done based on normal capacity. Next, as cost of inventory includes other cost also. Other cost means cost which are incurred in bringing inventories into present location and condition. Next, what are the costs which are excluded from cost of inventory? Abnormal waste. Abnormal waste will be excluded. Abnormal waste of materials, labor, other production cost. Second, storage cost will be excluded. However, if storage is part of production process, such storage cost should be included in the cost. Example, storage cost incurred in production of wines and pickles, it will be included. Third, office and administration overhead. Fourth, selling and distribution overhead. Fifth, interest and finance charges. When inventories are bought on deferred settlement terms, the financing element. Example, a difference between purchase price for normal credit terms and the amount paid is recognized as interest expense over the period of financing and not included in the cost of inventory. Such interest expense will be charged to P&L account. It will not be added to cost of inventory. That means it will not be capitalized. Next, allocation of cost to joint products and byproducts. A production process may result in more than one product being produced simultaneously. This is the case when joint products are produced or when there is a main product and a byproduct. In case of joint products, when the cost of conversion of each product are not separately identifiable, they are allocated between the products on a rational and consistent basis. Allocation may be based on relative sales value of each product, either at the stage in production process when the products become separately identifiable, that is at separation stage, or at the completion of production. So the allocation will be made based on relative sales value of each product, either at separation stage or at completion stage. In case of byproduct, most of the byproducts are immaterial values and therefore they are measured at net realizable value. The net realizable value of byproduct is deducted from cost of conversion. The net cost of conversion, that is cost of conversion less net realizable value, is distributed among the main products. So byproduct will be valued at NRV, and that NRV will be deducted from cost of conversion. Such net cost of conversion is distributed among the main products. Next, cost of agriculture produce harvested from biological assets after the point of harvest. Agriculture produce after the point of harvest falls under Ind AS 2. Such inventories are measured on initial recognition at their fair value less cost to sell at the point of harvest. In accordance with Ind AS 41 agriculture, inventories comprising agriculture produce that an entity has harvested from its biological assets are measured on initial recognition at their fair value less cost to sell at the point of harvest. The fair value less cost to sell, as determined in accordance with Ind AS 41, will become the cost of inventories at the date for application of Ind AS 2. So fair value less cost to sell will become the cost of inventory as per Ind AS 2. Fair value less cost to sell will be calculated as per Ind AS 41. That will become the cost of inventory as per Ind AS 2. Next, cost formulas or cost methods. If inventories are ordinarily interchangeable, there are two methods: historical cost method and non-historical cost method. Under historical cost method, we use either FIFO or weighted average. In case of non-historical cost method, we use either standard cost method, retail method. If inventories are not ordinarily interchangeable, specific identification method is used. That means specific cost is allocated to identified inventory. First, historical cost method. First, non-historical cost method, that is standard cost method. Standard cost method, it takes into account normal levels of materials, supplies, labor efficiency, and capacity utilization. They are regularly reviewed and revised where necessary. Second, retail method. This method is often used in the retail industry when items of inventories are rapidly changing and have a similar margin, and for which it is impracticable to use other costing methods. How to calculate cost of inventory using retail method? Selling price of the inventory less appropriate percentage of gross margin gives cost of inventory. An entity shall use the same cost formula for all inventories having a similar nature and use to the entity. For inventories with a different nature or use, different cost formulas may be justified. Next, net realizable value. NRV. How to calculate NRV? Estimation of NRV in case of finished goods. How to calculate NRV in case of finished goods? Estimated selling price in the ordinary course of business less estimated cost to make the sale gives NRV in case of finished goods. Estimation of NRV in case of work in progress. Estimated selling price in the ordinary course of business less estimated cost of completion applies in case of work in progress, less estimated cost to make sale applies both in case of finished goods and work in progress. We will get NRV in case of work in progress. Estimation of NRV for raw material to be used in finished goods. NRV for raw material to be used in finished goods. If finished goods is sold at cost or above cost, then NRV of raw material is considered to be more than cost. Then measure raw material at cost. If finished goods is sold below cost, then NRV of raw material is considered to be lower than cost. Measure raw material at replacement cost. Replacement cost means it is the amount that an entity would have to pay to replace an asset at the present time according to its current worth. NRV are based on the most reliable evidence available at the time the estimates are made. These estimates of NRV take into consideration the price fluctuations occurring after the balance sheet date to extent that such event confirms conditions existing at the end of period. For example, if an entity has 100 items of A at the balance sheet date, NRV of these items on the balance sheet date is rupees 60, and some goods are sold after the balance sheet date and before the approval of financial statements at rupees 50. The entity should consider rupees 50 as NRV for comparing with the cost of inventory, not rupees 60. Next, writing down of inventory to NRV and reversal of write downs. Write down and reversal. Writing down inventories to NRV. When NRV is lower than cost, then NRV is measured at NRV. Then inventory is measured at NRV and difference between cost and NRV will be transferred to P&L as a loss or expense. Next, reversal of write-downs. A reversal of write-down is permitted maximum to the extent of loss previously booked only when circumstance of write-down below cost no longer exist or when there is clear evidence of increase in NRV. Next, derecognition of inventory. Derecognition occurs when inventory is sold or inventory is used in construction of PPE, property, plant, equipment. If inventory is sold, carrying amount of the inventory is recognized as an expense in P&L in the period in which revenue sales is recognized. If inventory is used in construction of PPE, carrying amount of the inventory is allocated to PPE, property, plant, equipment, and will be recognized as an expense in P&L over the PPE's useful life. Next important point is when PPE is used in manufacturing of inventory, depreciation of PPE will be added to cost of inventory. Decommissioning cost due to manufacturing of inventory will be added to cost of inventory. Purchase cost will be added to cost of inventory, whereas selling cost will not be added to cost of inventory. Opening plus purchases minus closing gives raw material consumed. It also gives sales or cost of goods sold.